To Quoted Data's weekly news show. James is on holiday this week, so I'm going to be running through the sort of highlights of the week news from the world of investment companies. Then we're going to be bringing on Andrew McHattie for his sort of regular slot, where he's going to be talking about the sort of major moves in September. And then finally, we sort of ended up with a bit of a gap in our programming schedule, so we can do something a bit different. Andrew and I are going to sit down and basically talk about the major themes in the sector. So stay tuned for that. There's actually a lot to go through. I think that's actually going to be really interesting. Sort of first, the news this week from the world of investment companies. There were sort of four things that I wanted to talk about. First of all, is sort of JP Morgan emerging markets. We've had an announcement there. There's also been an announcement from sort of Saba. They're going to be sort of putting together an ETF investment trust. We'll talk some more about that. Also, sort of related to that, Seacrest Natural Resources Growth and Income has completed its sort of Saba-related redemption. So something to talk about there. That's sort of quite interesting the way that's all worked out. And also, we've had final results and some sort of interesting developments from Bearing Emerging Opportunities. So starting with JP Morgan Emerging Markets. So we've had a set of final results. Key takeaways are it's another year of sort of NAV underperformance. So NAV was up 4.9%, but that was behind MSCI Emerging Markets, which was 6.3%. Bit of good news, share price was sort of 9.8% total return because discount came in about 12% to sort of 8.2%. Driver of that was repurchases. They did quite a bit, 8.8% of issued share capital at the beginning of the year, which has added about 1.4 pence to the NAV. Couple of sort of changes sort of reflecting the challenges that it's facing. They're going to be sort of latest trust to introduce a new enhanced dividend policy. That's going to be sort of 4% of NAV, and there's going to be a name change to reflect that. Now, talking about its performance, because really that's where a lot of its problems lie. It is a decent sized trust. 1.26 billion market cap, discount 8.2%, yield 3.5%. But if you are sort of looking at the 1 year chart that I've got here, you can basically see that really it's largely flat across the year. It obviously dropped down in advance of the sort of tariff announcements in April, really responded negatively to that, as did pretty much everything. And then it's had a sort of good bounce back. Now we're actually sort of a little bit ahead. But really the sort of big story is if you look at the sort of 10-year charts, you can see in the first 5 years, really up until sort of COVID, it was actually making pretty decent progress. And then obviously you get the COVID downdraft and a sort of big bounce back. And then really it settles down. And if you look at it, the last 5 years, it's just not gone anywhere. And this is the point. So next slide is also sort of taken from our website. It's the sort of emerging markets peer group. And what I've done in this table is I've sort of ranked it all by 5 year NAV total returns. And those figures you're seeing there are sort of, you know, your annualized figures. And basically JMG over the last 5 years, it's basically giving you 4.1% per annum, which puts it pretty much at the bottom of the peer group. The only sort of fund that's really done worse than that is sort of JP Morgan Emerging Securities, obviously what was JP Morgan Russian. Which got carried out really once Russia invaded Ukraine, and we've sort of discussed that obviously on the show and on our website in detail, so I'm not going to go into that further here, but really that is the sort of long-term problem with it. Now, obviously we've got this new enhanced dividend policy, 4% of NAV, or whatever that is at the year end, and it's going to be paid quarterly. That's going to more than double the sort of current dividend. You can get 4 equal payments, no change to the mandate strategy, same managers. And the board says it believes this sort of combination of high growth and income will further differentiate the company from other emerging market offerings. I think there's some debate about that, but we'll sort of come back for it. Anyway, there's going to be a name change to reflect this. So it's going to be, you know, JP Morgan Emerging sort of Growth and Income. Alongside that, you're going to get a sort of 25% conditional tender offer in 2030. Basically, if it underperforms the MSCI Emerging Markets Index over the next 25 years, that's going to trigger this tender. We think really boosting up the income in this way is going to put it in direct competition with sister fund Gemi. Will this cause confusion? Well, we think it probably will. Next slide, there's sort of vast difference in performance between the two. We think maybe sort of longer term, this could actually result in pressure to merge them, but we'll obviously see. But next slide, two funds I've highlighted are obviously JP Morgan Emerging Markets, and then obviously JP Morgan Global Emerging Markets Income. And if you sort of look on the left-hand side, you can see that GEMI has sort of consistently outperformed, and particularly if we go those 5-year numbers, it is sort of well ahead. And I think this is sort of fundamentally the problem. We think, while, you know, this is nice, it's ultimately not going to distract from the sort of significant performance issues. If you look over the sort of last 5 years, GEMI's ahead of JMG by almost 38 percentage points sort of cumulatively. And you know, I can't see anything really in these proposals that's going to address that issue. Now let's sort of talk about Saba. Saba have come up with an announcement this week that it plans to launch an active ETF targeting London-listed investment companies and trusts. It's going to be called the Saba Capital Investment Trust UCITS ETF. It'll be domiciled in Ireland. Basically, paperwork's gone in. It's awaiting approval from the Irish regulators. It's going to be the sort of first ETF or active ETF to target the UK-listed closed-end fund sector, which, and I think here sort of illustrates the problem. We're going to be talking a lot more about this later. But if you exclude 3i, the sort of sector's trading on an average discount about 14%, and there is your opportunity. Now, I think with the announcement of this ETF, it's quite clear that Saba recognises the latent value hidden in many UK-listed investment companies. And the question we keep asking ourselves is, why are so many other investors just happy to pass on this opportunity? Our thoughts are that if they can actually bring in some sort of decent external capital and actually provide some demand, this could help narrow discounts and benefit all shareholders, really, sort of in, you know, UK-listed closed-end funds. But we also think, ideally, these sort of ETFs, they need large, liquid, underlying holdings with sort of tight bid-ask spreads to work properly. And not all investment companies are going to be suitable. I mean, one of the strengths, actually, is that you can have sort of small investment companies investing in less liquid assets. They're not going to be suitable for this sort of kind of thing. Our other big concern is, historically, as we saw with its sort of targeting of what it described as the miserable seven, it's not been judicious in its choice of targets. And that's a sort of bit of a worry for us. The other thing that sort of plays on my mind a little bit is that actually there are already good funds with an activist slant targeting investment company discounts. So you think of AVI Global Trust and sort of Migo Opportunities. And here's a key difference with the ETF. Both have their own boards to hold the managers to account. Both are available on tight discounts too. What does sort of history tell us? Because it's not the first time, although this is an ETF structure, it's not the first time funds have been sort of set up sort of quite aggressively targeting discounts in this way. We think shareholders should think very carefully about dumping their holdings and piling into Saba's ETF. We think they may be better off where they are already, because history has shown with sort of things like Sherborne Investors, which targeted Electra, you would have been better off holding Electra, hands down. There is no sort of real competition there. Now, the next thing kind of related to this, I want to talk about CQS Natural Resources. Now, this was one of the 7 that Saba targeted in its campaign that decided or started right at the end of December last year. And for those who've been following this, they were resoundingly defeated in all 7 requisitions. Now, they came back with sort of targeting 4 of the other funds, CQS Natural Resources included, with proposals to open-end it. And sort of our gripe with this, or amongst a number of them, was that there was a strategic review underway already that was already looking at the potential to do something like that. Hands down, I don't think that that is the right strategy for that fund, because when you're talking about sort of small and medium cap mining stocks, and this is a very specialist fund, there's sort of not really the liquidity to properly open-end it. It just would not work properly. And I think people that really understand that fund appreciate that. And it's got a very, very loyal band of investors. Anyway, clearly that wasn't the right way forward. But what they did agree to do was, let people out at sort of NAV, and they provided 100% tender. And they sort of announced the results of this on the 1st July. 45% of the shareholders tendered their shares, obviously bearing in mind that Saba had, I think, approaching 30% holding in the fund at the time. Now, they've now completed selling the tender pool. And the tender price you've got is 208 pence per share, which is 45% lower than the current market price of 303 pence per share. because we've basically seen some really big advances in stock prices, particularly in sort of gold and precious metal during the last 2 months. And we were sort of saying at the time that actually there's a huge amount of sort of hidden value in the portfolio, and that investors should think twice before cashing in their chips. And we think this sort of whole thing really illustrates the problems with some of Saba's targets. Herald was another classic one. It is a challenge to try and liquidate a pool of small and medium cap, sort of, in this case, resource stocks, in a hurry. The rest of the market sees you coming. Obviously, the discount narrowed following the tender announcement, and as I said, we've had a sort of stagflation environment, which has been good for sort of gold and silver. This was something that the managers have been sort of talking about for a long time, and sort of very much leaned into that theme. And in fact, I think accelerated that sort of recently. So, 46% of the portfolio was in precious metal miners at the end of August. And this has really helped sort of drive up its returns. So that August rally has pushed shareholder returns to 230% over the last 5 years, well ahead of its two benchmarks, which are the MSCI World Metal Mining, up 75.75%, and the sort of MSCI World Energy Sector Index, which I think is up to 173.8%. It is worth remembering that obviously that tender came with other sort of value enhancing measures, which clearly sort of benefit all remaining shareholders. So there's cutting the annual management fee to 1%, and they've brought in this sort of 8% dividend policy, which is something we're going to be talking about, enhanced dividends, later. Overall, we think that although CQS, sort of Natural Resources, is now a fair bit smaller, it's actually emerged in better shape for investors that are continuing. And I'm saying, if you had continued, you've obviously had the benefit of that recent sort of surge in performance. So lastly, I want to talk about sort of bearing emerging opportunities. It's basically sort of come out with an announcement this week that it's going to be sort of rescinding its 25% tender offer that it had sort of committed to doing. To sort of recap, back in October 2020, BMO set out some proposals for its future. There were obviously some clear challenges at the time, but it's proposed broadening its geographic scope. There was a name change, they reduced the management fee, and they put into place this sort of 25% conditional tender offer. And there were two things that were sort of potentially trigger that. So if the average discount was above 12%, and that was obviously the discount part of it, side of it, on the performance side, if your sort of NAV total return was less than 50 basis points above the benchmark per year, then that would also trigger it. Now, BMO has met the performance target. It's beaten the benchmark by 1.4% per annum, aided, of course, by the last 2 years, which has seen sort of strong recovery. This is despite being hurt by sort of Russia's invasion of Ukraine. So I think it had about 17.6% in Russia on the 25th of February, when obviously all of that happened. Now, I suppose the sort of big challenge here is it's a small fund, and sort of board has recognised this. Market cap, sort of 94 million when I was looking at this yesterday. Board is saying a 25% tender is not in shareholders' best interest. Basically, it's going to make the thing subscale. It's going to significantly reduce its size, ergo its liquidity. It's going to push cost ratios up, and board has estimated that really it's going to push those up to a level that's just not acceptable, makes the whole thing unviable. They reckon on that basis to continue with the sort of current structure would be challenging. So they've been considering alternative proposals. And what they propose to do is offer shareholders a vote on BMO's continuation, basically as it's presently constituted. Okay. But there are, if the continuation parts there or vote passes, it's going to do some things, obviously, try and help shareholders. If it does, it's going to put in this enhanced discount control mechanism and enhanced dividend policy. It's going to update its investment strategy. It's going to put in place 100% additional tender offer. It's in the meantime going to offer annual continuation votes. It hasn't been doing sort of buybacks particularly. It is going to introduce those. As I say, there's going to be a new progressive dividend policy, and that's going to be a combination of income and capital. And a big part of the sort of investment strategy is they're going to increase concentration. Now, sort of taking away a tender offer that you have promised shareholders is undeniably controversial. Some people are not going to be happy about this. I think shareholders have bought in to sort of try and capitalise on the tender coming up. Clearly going to be disappointed. But I think, if the fund is kept going, clearly, it's still got these Russian assets, albeit, they're sort of held at zero. If it's kept going, there is the potential to capture upside if those Russian assets subsequently found to have value. As we've seen in recent performance, manager has shown his ability to beat the benchmark. Thinking from the board's perspective, it's faced some pretty difficult choices. Clearly, if it proceeded with the tender offer, that was going to leave BMO subscale. There just really wasn't an obvious solution. We think with what they've sort of come up is kind of a sort of fairly good compromise, just given really, the challenge they faced. It just really makes the best of a difficult situation. Not entirely sure about the 100% tender. We kind of figure that if it's got persistent underperformance, if that's a word of return, you're just going to have the thing voted down every year when the sort of annual continuation vote comes up. We would also like to have seen a bit more detail on the enhanced buybacks. It hasn't really said what they're doing there. Anyway, that's all we had to say to sort of news this week. Now I'm going to bring on Andrew to talk about the sort of major moves in September. Morning, Andrew.
Morning, Matt, and thank you very much for that. I think maybe the word is Schadenfreude, isn't it, when you were talking about CQS natural resources?
Absolutely. Be careful what you wish for, I think. It's
grand. Well, I'll talk about what's been moving during the month of September. And I think actually there was a continuation of many of the trends that we saw developing throughout the summer. And I promise this list has been updated for this month, but it does look a bit similar to the list I produced a month ago. So we've got actually some very good moves again from commodity trusts in particular at the top, with gold and prospect precious metals keeping its place at the very top. And it was generally a good month for the markets and for investment trusts. So I think the average rise in the trust sector was just over 4%. And so you can see here lots of decent double-digit gains. The theme is very clear, the commodity trusts at the top. And I'll also talk about a couple of the biotechnology trusts that have done well. And I think there's something of a change occurring in that sector. So some decent rises and actually not too many bad fallers at all. I think the JP Morgan Emerging EMEA Trust is a special case, a special situation. Other than that, actually, only Gore Street fell by double digits. So there were not too many losses to worry about. But again, I do think there was a theme here, and that's once again, actually, the renewable energy infrastructure sector struggling a little bit to emerge, I think, from its difficult adjustment to the higher interest rate period. So again, I'll talk about that a little bit. So let's start with commodities, which really is the big story of the summer coming through into the autumn now. And I was quite intrigued to see if the rally in commodity prices had been across the board or whether it was really just about gold and precious metals. And I think these two charts tell the story quite clearly. So on the left here, we have the Goldman Sachs Commodity Index, so the broad-based index, and that's showing the last month. And you can see that whilst it's had its ups and downs, it's really made no progress at all. So it's not that all commodities are rising. This is very much about gold. And you can see the last month there in the gold price on the right-hand side, which shows that the very strong rally we saw through the summer has continued absolutely unabated, and gold has been going up more or less in a straight line. So that's really very impressive performance by gold there. And I think that's really driven what's been happening in this sector. So certainly gold and prospect precious metals, and I think many of the other commodity trusts as well. That's a really interesting point. We've lost the slides for a moment, but I expect they'll come back. It's a really interesting point, actually, is just how much exposure these other commodity trusts have to the gold price. And I checked that, actually, from the last monthly fact sheets. And I noticed that BlackRock World Mining actually had a pretty good exposure. I think it was 36% or so to gold. So that was really excellent, actually, and that explained why it's participated very strongly in this rally. And with CQS Natural Resources, actually, it's even higher. It's about 46%. So there's a very good reason, actually, why those trusts have participated in this strong gold-driven rally. I'm just going to flick over to my to my own screen here, just so I can see the slides again. We have, of course, seen this tremendous rally in gold that I talked about last month. And I really think it's been such a perfect storm for gold, so many factors moving in its favor at one time, that in a way it's not surprising that this rally has continued so strongly. And I don't know if it's going to carry on. Gold's getting pretty close to that magic $4,000 per ounce mark, and I wouldn't bet against it going through there. So we could see further strength in this to come. You might have noticed from that list of risers that Geiger Counter was also on the list, completing the commodities clean sweep at the top. But actually, that's a bit curious because it's an outlier here because it doesn't have any exposure to gold at all. But actually, the uranium price, which is not a public price, but there are consultancies that show an indication of the price, the uranium price has also been rising actually quite nicely of late. So that explains, I think, why Geiger Counter is also on the rise. I can see we've got the slides back now, so I'll
apologies for that.
All right, I'll just go to the correct one. Sorry, bear with me. I can't control them at the moment, Matt. So
oh, hang on.
Just,
sorry, I'll just. Right, all yours.
Lovely, thank you very much. Yeah, so just to catch up, that's actually a reproduction of a slide I produced last month, just showing you the perfect number of drivers for the gold price. And here we've got at the bottom the uranium price, which is not public, so it's quite hard to find. But you can see again, it's rallied nicely through the summer, and that explains, I think, why Geiger Counter has joined in this rally with these other commodity trusts, which are very much driven by the gold price. So that's quite interesting. And I think something else I've really noticed and been really pleased about is that the biotechnology sector in the US has finally picked up a bit of steam, because I think this has been somewhat depressed for a while by a lot of the political noise that's been going on. But we've really seen, I think, the sector ignited by quite a number of M&A deals all coming along at once. So it's been a really busy period for this. So this week we saw International Biotechnology Trust and RTW both announced that their portfolio holding in a company called Merus had been taken over at a 41% premium to its prior share price. And that's indicative, I think, of a lot of the implicit value in these trusts. So the IBT managers say that this is a flurry of activity that they think could gain further momentum. They've already had 7 M&A deals in their portfolio this year, and they do target these. So that's been working out actually very well for them. With biotech growth trusts, again, the managers are pretty positive. They say that a lower interest rate environment together with a valuation gap could really reinvigorate interest in the sector. And again, their largest holding in a company, Avidity Biosciences, has been approached by Novartis. So again, there could be a takeover there. And RTW has had 3 recent takeovers. And I think it's quite interesting just to look at the premiums here because they're quite significant. Merus, I said, was a 41% premium. There's a company called Alcyone Therapeutics, which was actually at a 242% premium to the carrying value. And then Verona Pharma in July at a 23% premium. So the uplifts are really very considerable. And this is a key driver that's really igniting interest in this sector again. And I think it's got some ground to make up. So I think the politics have really been hanging over this sector just casting a great big dark cloud over it. But there are signs of change. And I think a lot of this has to do with President Trump, of course, and his dislike of high drug prices. But it's quite notable that the US has struck a deal with Pfizer this week that enables drug prices to come down for certain groups and to be sold directly. So I think that's a template for other major farmers to follow. And I think it could actually really help this sector. And it has lagged. So this chart shows you in the yellow here, it's the mainstream NASDAQ 100 index, which has had a great time. We know that. This is a 5-year chart. It shows it moving up strongly. And then the blue line is the NASDAQ Biotechnology Index. And you can see that's had a very different experience. So it's a very wide valuation gap that's opened up as a result. There's been a wide performance gap here. And I think actually there's good scope for biotech to make that up. And maybe the fire has been lit now by this M&A that's going on. So I'll move along again to now renewable energy infrastructure, looking at the fallers. And I think it's been a little bit depressing where we've looked at these massive discounts, and I sorted this table by the discount to NAV with the tightest one at the top, going to the widest one at the bottom. You can see the discounts generally are very wide. The Downing one is an outlier because that's being taken over. And I think the hydrogen capital growth one, which is currently suspended, is also an outlier because that's about to have its NAV slashed, I think. So generally speaking, the discounts are very wide in this sector, and you've got some very attractive dividend yields. And I think many of those are covered. You could buy these and sit on a 9, 10, 11% yield to just to sit tight and wait for an improvement. I don't think that's necessarily a bad approach because there's a lot going on here, and I think boards are very, very thoughtful now. I mean, and they're really working on trying to do something to close these discounts. So there's a lot of strategy tweaks going on. There's a lot of new proposals. I've noticed that a few trusts are trying to prioritize growth now, and they're not spending quite as much of their capital on buybacks or dividends. And that's one of the subjects that Matt and I will come on to. And trusts, I think also they're trying very much to engage with shareholders a bit more, to be transparent, to produce news flow. So we saw, for example, from SDCL Efficiency Income, which has been targeted by Saba actually, they released an operational update this week, which wasn't really giving us too much in the way of extra news, and it wasn't anything to do with the NAV, but it was just fleshing out the information flow and trying to make sure that everyone is comfortable and feeling that they're up to date. So I think that in this sector, minds are being concentrated. There's still a lot more talk about M&A occurring, about potential mergers between trusts or trusts being taken out at these wide discounts. But we've been talking about that for a long time, and it hasn't really happened yet. We've seen one or two go. So the Downing one, for example, is going. But on the whole, there hasn't been as much of that as we anticipated. But I still think actually the short-term news flow here is going to be really busy. So it's not a sector to ignore. And I think there's quite good scope actually for some of that trapped value in those wide discounts to be released. We'll have to see how long that takes. So that's the end of the movers sector as normal. But I think this is going to be very interesting. Matt and I are going to talk about the current topics across the investment trust sector now. There's a lot to talk about, Matt, isn't there?
Yeah, no, there's a heck of a lot to get through. I'm sure we're going to scratch the surface, but clearly, yeah, there's a lot facing the sector, and I think it's just a great time to be kicking this around.
I think in particular, it's very helpful occasionally to step back and just talk about the themes that have emerged. Because, of course, we spend most of our time talking about events at specific individual trusts. But sometimes, if you do enough of that, as you and I both do, then certain things emerge that you see that are common across trusts, or things that are changing and things that spark our interest.
Yeah.
So Here's a list. It's quite long. There's 11 things. It's like a football team. We'll see if we can work our way through it and get to the forward line. All right. So we'll press on with...
let's kick this off.
IPOs. And this is a question I'm asked a great deal, actually, is, when are the new issues going to come back? When are we going to see a bit more vigor in the sector and some new things coming along? And I think at the moment, actually, if this was a normal period for the investment trust sector, we might well see some money going into AI infrastructure. There's clearly a massive build out occurring of data centers in particular, and a lot of the infrastructure that's needed for this huge expansion in AI. And the investment trust sector is not currently getting very much involved with that. A little bit through Cordian, perhaps, but I think during normal times we'd see that. But at the moment, it's just so difficult to get a new issue away because of the discounts.
Absolutely. Absolutely. I mean, to sort of give some sort of commentary on that, if you think about it, there are always costs to raising new issues. And so often you look at prospectus and they're sort of capped at 2%, which means that, invest in a new fund, although you're not paying the stamp duty that often you would if you were buying the secondary market, you're always probably investing about 2% premium. And that's a sort of huge issue when you can look at the existing market and you can pretty much see value everywhere. I mean, people often say to me, where do you see value? And it's just varying degrees thereof. And if you think about it, it's run back, a handful of years before sort of interest rates went up, and the renewables and infrastructure funds were, one of the darlings of the sectors. I mean, they could literally do no wrong. They were paying sort of nice inflation-linked, sort of stable, covered dividends. And clearly we need these assets. A lot of sort of aging infrastructure out there needs to be replaced. There's sort of demand for that. Clearly we need a lot of renewable generation capacity in whatever sort of form that takes. And these things were premiums and they were issuing stock. And they're able to grow and just get ever greater efficiencies. But today, I was just, before we came on, I just had a look at this renewable sector. Median discount 34.2%. Why are you going to pay us 2% premium when you can sort of pick up, an average discount of that sort of level from existing funds? Why would anybody new fund in that space? Similar thing, I had a quick look at infrastructure. Your median discount there, 18.2%. And that includes the fact that you've got some really good funds like 3i Infrastructure, which are, sort of one of the best in class, really. And interestingly, even if you sort of take DGI9 out, say the sort of average discount in that sector is still about 17.6%. And that sort of shows you the sort of strength of value. I think you're absolutely on the money where we should ordinarily be seeing money going into sort of AI infrastructure. And Cordian, that you sort of mentioned, that's really the sort of best representation. That you can go out and buy that today at a sort of 24.5% discount. Why is anybody, or how can anybody possibly sort of raise a new fund? And the sort of sad fact of it is that where you're sort of seeing transactions of the underlying assets, broadly speaking, they are justifying the NAVs. That's the sort of irony of this. And this is because private equity and the like are paying more than listed markets are prepared to pay for these assets. And they are sort of definitely paying up because they can sort of see, they are able to take a long-term view. I think another thing for sort of, where we see or previously saw a lot of the growth was in the alternative asset sectors. So many of those are income producing vehicles, sort of focused on yield. A lot of people value them on yield. And of course, against the backdrop of rising interest rates, there's just a lot more competition. It literally is as simple as that. And these guys tend to sort of face that in two ways. Not only are they competing for sort of, investors fund, they're also, because they've got these long-term stable cash flows by and large, those sort of structures are suited to debt. And so they tend to finance some of that with debt. And of course, with rising interest rates, rightly or wrongly, in some cases wrongly, investors have been really worried about that. So you sort of get squeezed from sort of both sides. And, one of the interesting things is, although we're not seeing IPOs, we are seeing quite a lot of good issuance from some of the debt funds. Because of course, they're on the other side of this. If you've got, sort of floating rate debt, and, there are the obvious candidates, the CQS New City High Yields of this world, Invesco Bond Income Plus, etc. These guys are actually doing pretty decent issuance. And I almost think that, if we were to see something, maybe it would be in that space, because that's something that, investors are demanding. But I think the other side of this, of course, if you look out in the world, there's a lot of uncertainty. If you think about it, we've got an uncertain macro environment, sort of inflation. Obviously, we've got tariffs, albeit a lot of that seems to have sort of drifted away, but who knows, that could pop up. I kind of feel that, a lot of problems with US policy are a bit like whack-a-mole. Something's going to appear. And obviously, various conflicts. So against that backdrop, that makes it equally difficult. If you're thinking of raising a fund, in many respects, it's easier to wait.
Well, you're right. I mean, that's a lot of hurdles.
You
listed a lot of reasons why IPOs are so difficult at the moment.
Yeah.
I think the bar is set so high, actually. There's got to be something really special and unusual about you to get an issue away.
Yeah, you've got to be differentiated. Yeah.
Well, you have. I think you've got to be offering something that's not currently there in the market, or you've got to be tapping into a theme that's really very hot.
Yeah.
And maybe the last one that came along, Achilles, obviously Harwood-backed trust that was buying stakes in other investment companies. That was the last one to come along, raised 54 million in February. Actually, it's done okay. I mean, the NAV is up a bit. The shares are trading at a premium to the NAV, which is the crucial thing. So it has been in demand. And I think it's quite interesting, last 3 IPOs, actually. That one's done quite well. And if we look at the prior 2, which were back in 2023, some time ago, Ashoka White Oak Emerging Market. Here's the chart of that one. Again, it's been good and has traded again very close to NAV because the manager has a very high reputation. This is the other one. Again, a very special niche one, Onward Opportunities, micro cap investor investing in AIM stocks. It started out as a tiny trust at 12.5 million. But because it's been trading at a premium for a lot of its life, it's been able to issue more stock and grow. So there is some positivity here. It is possible still to get a trust away and to grow it.
Yeah, no, absolutely. I mean, I think it is really interesting, isn't it? Because if structures, and I think this very much applies, if you've got a differentiated offering and you've got the structure, right, then, clearly you can tap capital markets. Although, as we said, there are a lot of sort of many difficult reasons why that sort of, is challenging. But anyway, I mean, it's really had that sort of clever fee structure, which they sort of proved with Ashoka India, and clearly the market like that, and they were quite happy to operate that, starting from a small base with the intention to grow it. Achilles is the one that I sort of really like, because the irony of that is that was set up to target discounts in the alternative asset sector, which is exactly the sort of problem that we're sort of talking about. And actually, if you sort of take a step back and look at Onward Opportunities, actually running a sort of small fund targeting these microcap stocks, that's a sort of difficult thing to do, but clearly the manager's got a track record and has been able to prove itself.
Yeah, I mean, I think that's the thing. We can talk about the special features of all of these. And I suppose if we're looking to then see what's coming next, you try and identify these special features, but often you don't see them coming. And until they arrive, you can't say what they are. But it's clearly a tough market. So I'm really expecting much in the way of IPOs. You did make a good point there that some existing trusts are, of course, able to raise fresh capital by secondary fundraisings. And we saw this week 24 Income doing exactly that in the debt sector. Yeah. So there's hope. But on the other side of things, there are so many wind downs occurring. And, I think this is an interesting point for me, that there's a lot of talk all of the time about the contraction of the sector. In some ways, it doesn't feel that bad at the moment, because you look at the statistical tables that we have and you think, well, there's not that many trusts have disappeared. We've still got a great corpus of existing trusts. But of course, in certain sectors, there's a lot on their way out, and it takes quite a long time. So I had a count up, actually, in the alternative asset sectors, and I found 21 trusts in the current process of winding down. And sometimes it's like dragging your feet through mud. It can take such a long time. example of that is Phoenix Spree Deutschland, where they were restrained actually by the covenants on their debt, putting lots of properties on the market to try and sell them off. But even then, it takes time. You can't dump hundreds of expensive apartments onto the market in one and expect to achieve a full price. And it takes time to sell property, doesn't it?
Yeah.
So unless you're attracting a bid for your whole company, actually, it's a difficult process selling this stuff. Particularly, as you mentioned earlier, Matt, everybody can see you coming. They all know you're a seller. And I've seen lots of examples lately where the sales prices achieved for assets have been really disappointing, actually. I put some on the slide there you can read for yourself. But
yeah.
I previously had generally thought that when a trust was winding down, as a shareholder, it was commonly in my interest to wait for the wind down to get to
absolutely.
Because the value's there and it was generally worth my while waiting. I'm a bit less convinced by that now, because actually quite often you think you're going to get a certain price for the assets, and then the prices are becoming a bit disappointing. Could be to do with the quantum of trust trying to sell things. Could be.
Now, and it is really interesting to take a step back from this, because, with the best will in the world, this is sort of competitive market. Not all ideas are necessarily going to work. I mean, this is the whole point of investing. You're taking some risk. Hopefully, you've got a professional manager in place. You've got a good board, and all of that is managed. But I think we should expect to see some creative destruction. Things that are not working should be modified, or ultimately shareholders should get their money back. Equally, as we were saying with the IPOs, in an ideal world, you need to be filling up that hopper, because just with the sort of move of time, things that were a good idea will ultimately sort of burn themselves out. It is quite interesting, the sort of point that you're saying that, particularly with the sort of growth in alternative assets, actually, I think we can expect some of these things to take a bit longer, because by definition, there's not the sort of liquid market in the same way for those assets. But purely by chance, I just discovered something that I used to write on years ago. And I was surprised when I discovered this. Do you remember sort of REN Universal Growth was run out of the US? Was formerly Renaissance US Growth, or Renaissance US Growth and Income.
Yeah.
This was sort of very good North American income fund. It had a sort of GARP approach, and it did very well. Then the sort of manager, Russell Cleveland, decided that the future was China. And I'm not going to say entirely bet the farm, but I suppose he is good as did. Put about 45%, I think it was, in these US listed Chinese stocks before the Chinese accounting scandal broke. And long and short of it, it got absolutely carried out. And really, they couldn't get past that scandal, because the sort of manager had lost all sort of credibility, just never came back. It delisted on the 15th of April, 2015. I found out yesterday, because I've forgotten about it. This was like a decade ago. It took a long time to actually wind out that portfolio. And I think they did get back a decent amount of value, but it was only fully dissolved on the 2nd of April this year. Fun fact.
You're right. Some of these, they take years.
Yeah.
A good example recently with Blackstone loan financing, where in the market, this wind down is going to take possibly 7 years. So in the end, actually, it accepted a discount and sold the assets. But it's a difficult process, I think, and sometimes the outcome can be quite disappointing. So to watch out for.
I think on one hand, one of the problems with sort of REN Universal Growth is this was an old school trust, and the manager, Russell, was on the board, and he had a lot of his friends on the board. There was another guy, George Cleveland, etc. You don't see that anymore. So, a lot of that shouldn't happen now. But it sort of kind of plays to the fact that actually why investment trust boards and making sure that they are good quality is important. And I think that's where the sort of market has moved on, is that although in some respects the assets have got more, what's the sort of word? Technical. And you've sort of got to understand sort of different facets of them. I think boards have geared up to deal with that, which is sort of comforting. I think in your thing you mentioned a killer European, and there are sort of few of the funds in this list. I mean, I think the sort of problems with digital and infrastructure are sort of well known. And I think you're right. So some of the prices that Adig got were a surprise, and the same with sort of hydrogen, etc. But something like Area, I was kind of disappointed to see that go, because I felt that was sort of differentiated. It was a decent size. It actually had pretty decent performance. It was broadly doing the right things. I just think if that had launched a bit earlier, before the sort of funding window closed, and it got more scale, it might have sort of been a different story. But yeah, I think the sad thing is investment company structure is the right structure for a lot of these sorts of assets, which is really why, the sort of challenge that we've got need to be sorted out. It becomes a bit chicken and egg, doesn't it? Because I think in some instance we've got some sort of quite difficult regulation working against us at the moment.
Well, that's right, and I do worry actually that one or two sectors might disappear most entirely. And the one I'm focusing on is the UK REIT sector in the closed-end fund structure.
Yeah.
This is the sector that shrunk the most, and I think we would possibly expect that because property is the most sensitive of all sectors to interest. But we've seen here trust being taken over and wound up. But worrying aspect as well is that we've also seen existing trusts that are perfectly good, doing well enough, and they are deciding to leave the sector by internalizing their management and standard property companies. And the reason is that they're saying, well, we can't raise any capital as a closed-end fund because you're focusing all the time on our NAV. If listed property company, people are looking at our earnings and our dividends, and we can raise some money. So I think that's very difficult. And we've seen a huge contraction here. And I do wonder, actually, whether we'll end up with any direct property companies left. We might just end up with our beloved TR Property.
No, I mean, I think, the regulation here is a big factor. I think cost disclosures have definitely played a part. It's a big issue if you're a REIT. Obviously, you've got to put in, the sort of costs. So you've got to disclose those in a different way, and you just suddenly look more expensive, even though actually it is literally just the structure and the cost disclosure rules. And you're quite right. I mean, this has led to this trend that seems irreversible of, if things are not getting wound up, bought up by, sort of private investors, etc., that are able to sort of take this long-term view, as we're saying, and sort of see the value. They're absorbing the manager, and they're just becoming a conventional operating property company, which to my mind is a sort of retrograde step in terms of governance. The fact that you've got this separation of manager and you've sort of a board that is independent and oversees that, and you can readily fire the manager and move the portfolio on, seems like a much better structure. If you internalize all of that, you can't. I mean, if you think about it, this is why over the years we've seen things such as sort of F&C split out its management company, etc. There's very much a sort of trend in that direction, and now due to this poor regulation, really we're getting this sort of retrograde step, and it just seems nonsensical. But if you were sitting in the position of a sort of supermarket income REIT, it would just make absolute sense. You can see why it's happening, but it is very disappointing.
Well, and I do wonder whether others are going to go that way. The numbers really shrunk so much, and of course this has an element of self-fulfilling prophecy as well, that if the sector shrinks so much, then it receives less attention and there's more impetus, I think.
You also end up as the odd one out, don't you, as well? That's another big worry about it.
So, let's move on and talk about debt. And there's a couple of elements of debt that have, I think, sprung up when I've been talking to managers recently. I mean, one is that, of course, what happened when interest rates rose is that trusts just found, they wanted to pay off their debt and reduce level of gearing, particularly in the alternative asset sector, where you can't avoid debt as part of the structure. If you're a property investor, you're going to have debts, and the same for renewable infrastructure. But you don't have too much, and the market worries if you have too much about you being able to after that. So debt reduction has been a big theme. And a lot of the asset sales that have been made in the sectors have been directed towards just repaying a bit of that debt. One thing I've noticed, though, is that quite a lot of the debt facilities that were taken out during the low interest rate period have now reached the end of their term or are doing so. So when debt is refinanced now, is coming out at a higher cost. We had an example recently, which I put on the slide here, alternative income REIT, where it secured new debt facilities, that was fine, but its interest payments went up from 1.4 million a year to 2.2, and it had to cut its dividend as a result. And we are seeing this actually, that we're seeing these higher interest rates flow through with a lag. There are some trusts, of course, that were clever enough or lucky enough to tie in, some cheap debt during that period for long periods. So I've listed a couple on the slide: North American Income Trust and Global Smaller Companies Trust. They 10 to 15-year debt at maybe somewhere between 2 and 3%, which is terrific, and that gives them a nice tailwind actually to perform for a while.
No, absolutely agree. I mean, I think, as we've said, this is all linked to higher interest rates and the sort of knock-on effect that has. And once again, particularly alternative assets, because so many of them are focused on generating income, but equally they're getting stable revenues, so they are well suited to being financed with debt. And as we said, it's a sort of big part of the problem with renewables and infrastructure. You've seen a lot of these guys, selling assets, justifying their NAVs, and actually, paying down some debt to ease sort of investors' worries there, in the hope that it, helps the discount, and also diverting some of that towards buybacks. I mean, for me, ironically, with a lot of those funds, of course, it's really not the problem that you might think it is, because a lot of their cash flows have got, well, obviously they're stable, they've got strong, they're always very predictable, but they're strong inflation linkage. So there might be a slight lag, but invariably higher inflation, higher interest rates, more revenues, uplift in the NAV anyway. But clearly investors are not investors are recognizing this. So clearly they've got to do it to try and get the sort of discounts down. It is interesting though what you say about sort of the structure and the fact, if you've been savvy enough to look ahead and actually lock in these low interest rates, you're in a sort of pretty good position now. So I think you really need to have a look at the structure of the debt. And one of the reasons I sort of raise this is I sort of think about Next Energy Solar, which on paper has got a sort of high level of debt, but the really clever thing about that is about 70% of it is sort of fixed rate. And I think it's these sort of preference shares they've got that are sort of quite long dated. And I was looking this morning, just looking back at some of the stuff we'd written, and I think they've got a sort of all-in rate of about 4.9%, which in some respects sounds quite high, but actually equally, of course, all of those projects could easily cover that. And if you take a step back, you think, well, with interest rates, even refinancing that, actually, when that eventually falls due, whatever those assets are, because they are throwing off a lot of cash flows, that should easily be covered. So I think you've just got to understand. I think in that case, that will be quite straightforward as a refinance when it comes around. You've got to understand really what it looks like.
I think you're right. It's beholden on us as analysts and people to really dig into the debt structures, ensure that the asset returns that are achievable are going to wash the face of those debts.
Yeah, absolutely.
I think for managers in the alternative asset space in particular now, it's a juggling act, because there's so much pressure on them to allocate their capital to share buybacks, to debt reduction, to dividend payments, and to new investments. And you haven't got enough capital to do all of those things, and you can't raise any extra capital now. And has, I think, caused anyway to deprioritize their dividends. And I can see from the questions actually that this is an important question. And it really is, because if as an investor you've been attracted to the alternative asset sector because of the high dividend yields, you're investing there as a long-term investor, thinking that you're going to be having a nice sustainable yield for several years, and then that goes away, that's a big problem. And that's why I thought it was pretty awful what Gresham House Energy Storage did last week, where they've decided to prioritize growth and said they need the money to invest in their pipeline, so they're only going to pay the minimum dividends they need to satisfy the investment trust regulations. And that's a problem for me, because actually only 10 months ago they had a 3-year plan where they said, no, we're going to reinstate dividends.
Yeah, absolutely.
That's an issue of communication.
Yeah.
Whereas, for example, Octopus Renewables have taken a different methodology, And they said, well, we want to put more money into construction and growth, but we are still going to maintain our dividend. It's just not likely to grow as rapidly as it might have done. So I think that's okay. If you say to investors, this is the best route for the trust, but we are going to look after your dividend. That's one. But I think sometimes it goes too far the other way.
Yeah, and absolutely. I think, as you say, the key thing here is that the sort of world has changed, and a lot of these guys, whereas they'd expect to be able to grow and get efficiencies and all the rest of it, that's no longer the case. So, we're in a situation where the capital is scarce and you've got these competing uses for it. And there is this big debate, about where managers should be, or managers and boards should actually be focusing that. Should they be focusing on investments? In an ideal world, that's actually what they should be doing. But of course, it's not that sort of simple. And I can sort of see, if you've got funds on big discounts, you've got to start to look and go, well, I can't make new investments, but actually, does it make sense to do buybacks and actually get some NAV accretion? Because actually that is adding value to your sort of remaining shareholders. I think it's really interesting what you say about grid, and that is a difficult one. I totally agree that they'd come out there with this plan, and it is very much a communication thing, and it is. There's a question needs to be asked why that's being turned around so soon. I know that underlying it, of course, the sort of cost of batteries has come down, and if you focus on the augmentations, you're moving from 1 hour to 2 hour, 2 to 4, 4 to 8, etc. As we're seeing, the payback on that is really short. So you can end up with this situation where there's this short-term payment. You actually end up with a sort of much stronger portfolio, because these longer duration batteries are much more flexible in terms of the revenues they can generate, so you can get a lot more out of them. And I think that's really why they're focused on that. But this comes back to another point we make, that you've really got to focus on getting your messaging right. And there probably would be some explanation as to why, very not that long ago. In fact, for my sins, I picked grid as sort of one of my spicy ideas for our analyst picks for 2025, which actually the halfway point was doing very, very well. I've not been back to look and sort of see what it's doing, but part of the reason was they'd set out this really good plan, and now obviously they've sort of turned sort of face on that, at least in part of it. And I think explanation is due.
And I think there's a bit of tension now arising as well that we haven't seen before between managers and boards, where they're not necessarily singing from exactly the same song sheet. That managers want to invest in their portfolio, and boards are of course under pressure from shareholders to give money back, take care of the discount. And so I think there's a bit of extra tension there that might see coming.
It is a difficult path to manage. And as I say, if you look at the battery storage funds, of course, have faced all these other issues with National Grid's ESO software, etc., and not sort of utilising those properly. And a lot of those issues seem to be being overcome. As I say, with grid, the cost of batteries has come down quite a lot, so you can kind of see partly why that's happened. But you just got to get your messaging right.
Yeah, I think one other aspect of dividends that comes up a lot now, and I think this is where I have a minority viewpoint actually, so it's always interesting to talk about it, is enhanced dividends. So more trusts now are paying dividends out of capital, and we saw an interesting one actually last week. Dunedin Income Growth, a constituent of the UK equity income sector that hasn't performed particularly well and doesn't stand out in my view, and board is trying to give it some kind of marketing edge, I think, by pumping up the yield and saying it's going to pay a bit more out of capital. And it's justified this in part by saying, well, actually, our investee companies are not giving us all of their money back in dividends now. They're also buying back their own shares. So we're just reflecting that. And I thought that was a specious argument, actually. But then I also saw that Temple Bar had said very much the same thing. And they're using a bit of their capital every quarter as well to enhance their dividend. And there is actually quite a lot of evidence to say that actually putting up your dividend yield in this way really helps the share price rating. And so boards are being very tempted to do this. My view is that I don't want you slicing off my capital and giving it back to me every year. I've just invested in your trust. They don't give it back. And I also think that creating the dividend in this way runs contrary to the beautiful transparency and simplicity of the industry that we've always really valued.
Absolutely.
And I think there's a case to be made that actually some investors are being a bit misled here because they think that these yields are genuinely being created by the underlying portfolios.
Yeah.
And they're not.
Yeah. No, I think take this as it's meant and perhaps sort of not as it sounds. I think your view, and I ascribe to it a lot myself, certainly traditionally, is very much a sort of an old school way of looking at things.
Yeah.
Okay. I think we have seen so many funds run into sort of trouble traditionally where they have over distributed and, you know, ultimately they run out of road. You say you are sort of chipping away at the capital, but I am of the view that you are quite right. Certain funds that can provide a decent yield because investors want that, sort of see a premium rating. You know, you can think of sort of various trusts that have sort of enjoyed that. I don't think it's necessarily the solution that everybody thinks it's going to be. It's not always enough. It's got to be a sort of decent yield. And I don't have a sort of major problem with playing a bit of the dividend out of capital, providing that, you know, actually fund is set up in such a way that there should be over the long term plenty of capital growth going through. So that actually, if overall you're taking a bit of that and converting into income because that's useful and it saves the investors doing that themselves because they probably want the income, provided that's readily covered and actually you're still getting the capital building over time. I think that works. But I think, you know, if you, and this is something that sort of worries me, what is a acceptable level? And obviously it depends on the underlying. But you know, you're sort of seeing some funds saying, right, we're going to do over 6%. Does that work over the long term? You know, so a lot of compound returns, actually, yes, it will, but not always. So you see, you can end up with this problem in the same way that people are sort of forced to cut their dividends. Eventually, you're forced to do something because ultimately you're not providing a sort of, you know, enough return, and the capital is just being chipped away at. I think that is really the argument. Maybe some more analysis around that. Maybe the onus is on us to do a bit more on it.
Well, it could be, and of course, this is perhaps an example of boards listening to their shareholders and a reminder these trusts only exist for their shareholders. If their shareholders are saying we'd like a bit more income, then they're responsible.
Yeah, absolutely.
I'm conscious of the time, but I thought it'd be useful maybe to talk about discounts across a range of sectors just to see where we come. Because my sense, Matt, is that actually discounts are not wide across the entire sector. I think there's quite a lot of subsectors where actually discounts are quite tight, in my view. I've ranked with the narrow ones at the top. And you were saying earlier that you thought maybe in the debt sector there could be some issuance and that sector premium. And then we have several actually where the discounts are narrower than 5 or 10% on average. Equity income, Asia Pacific income, Europe, commodity, UK growth, UK equity and bond, global. I think those are all fine actually. And of course you may get the odd trust in that sector that's an outlier, which could. But overall, I don't think in the march of history discounts are wide there at all. They are wide in certain sectors, but I think because we're spending so much time focusing on alternative assets in particular, that's where they're really wide and where there could be more opportunity perhaps.
Yeah, no, absolutely. I mean, once again, if you look down your list, in so many instances, these are in sectors where, for whatever reason, they're interest rate sensitive. And, you know, that is a sort of recurring theme. Once again, I think you've got to sort of take a step back and go, okay, you know, to what degree does that sensitivity matter? Coming back to what we were saying about renewables and infrastructures, you get good pass-throughs, so that's not necessarily an issue. But once again, it's just about understanding them. And property is another one because, of course, for the reasons we've discussed, people worry about that. But in sort of many respects, these guys, a lot of the rents will tend to edge up with inflation anyway. So there's at least a partial offset there. Once again, you just got to dig in and really try and understand the numbers. But a lot of these discounts still look way too high to me. Looking at the size of the renewable energy infrastructure discount, for example, that to me, and actually those the sort of top there, it looks like a lot's baked into the price to me. If I'm honest, they just so many of these do nonetheless look overdone.
I mean that's one of the questions that's been asked actually.
Yeah.
What is the scale of the opportunity here? Can we buy into these wide discount sectors and it's money from discount narrowing? And nuanced. It's a nuanced issue because, of course, there are traps, aren't there? Because
absolutely,
wide discounts can narrow in one of two ways. Because the share price can go up, but it can also be the discount closing by the asset value coming down.
Yeah,
been quite a lot of that going on, haven't we?
Yeah, no, absolutely. I mean, this, and I think there's even debate amongst professional investors about this. Go back to what we were saying earlier. Sabre has launched this ETF because, of course, it sees value, and why aren't more people doing so? Now, sort of last week, I was talking to a sort of, not going to out them, but a very well-regarded sort of fund manager who invests in investment companies. And we were debating about where there was value. And to be honest, we've been talking about a lot of things we've been talking about today. So, your sort of renewables, property, etc. And, this manager felt that actually a lot of the property, in their view, was overdone. And I just look at, where these were once upon trading and thought, no, the discounts are still too high. And I ran some numbers on it this morning, and, you've sort of got a median discount about 25%. I think that was a UK commercial property, and you can see that these assets, and they're not like they're sort of offices, etc. Primarily, there's a lot of reasons why actually there could be decent upside there, and I think once again it's just about being able to look through and understand that. But I think on those level of discounts, once again, there's really a lot of negative news baked in, and if you think about it, the sort of mega opportunities in the AVI globals of this world, they have made money by sort of looking at these and buying them and being patient. And I think that sort of that very much can be done. But there's no guarantee of sort of when you're gonna get that catalyst. It just requires patience.
Well, it does, and I always look to see what they're buying. Of course, that's part of what we look at. And actually, just sticking for a moment, so I think maybe we'll go over this quite quickly, but in the renewable sector, I think one of the difficulties that people have actually when they're looking at these trusts is to try and understand exactly how the NAV has moved up and why because it does have sensitivity to so many elements that somehow they seem like a black box. And there's inputs going in and figures coming out, and there's a lot of assumptions and consultants are used to look at power price curves and so on. And I think if you're an external investor and you're not an expert in renewable energy, it's tremendously difficult to weigh up what risk is and also how these things are going to move. So just on the chart there, you can look at it later. There's some figures about potentially falling power prices, but actually I take the view that these future power curves could move either way, and a couple of years' time they could look different in either direction.
Yeah, no, absolutely. I mean, I think in a way, in a sort of lower interest rate environment, perhaps the sort of sensitivity and the focus was more what might happen with that. Of course, that's now happened. This almost seems to have become more relevant than it once was. And I think maybe, sort of things like the invasion of Ukraine, that pushed up the gas price in the sort of short term. And actually, everything was coming in above, and a lot of these curves actually were shifted up, and then they sort of dropped off. And a lot of that has kind of rolled out. So you can see in a way how this has become more relevant. But my sort of big concern is that there are a lot of assumptions built into these. It's great that we've got these independent forecasters, because it provides precisely that. It is an independent forecast. Not only in theory does it save us doing it, we're sort of separated from that decision, as are the managers, which I think, just helps with the objectivity. But I think really it's time for, the likes of you and I maybe do a bit more work on this, because all of these things are relying on a number of assumptions. And the more that I sort of kick the sort of tires on this, the more I think, actually maybe there could be some upside here. For a start, one of the things that these sort of power price forecasts assume is that, new nuclear generation is going to come in on time and on budget. And quite frankly, our track record of achieving this, don't want to slate good old Blighty, but I mean, it's just shocking. Every major infrastructure project comes in late and hugely over budget. So that's problematic in itself, isn't it? And I think, another thing, I have a feeling, obviously there's lots that's got to happen in terms of moving towards our net zero commitments, etc. But and a lot's going to happen to the grid infrastructure, etc. But I don't think these are really taking account to the sort of full extent of EV rollout, and actually the extent that we're going to have to move to electric heating. I think there's probably some sort of upside there. And of course, the other classic thing is these all assume, a base case scenario. There's never anything in there for shocks. There's never anything in there for, an invasion of Ukraine, which, as we saw, just shifted these things up. And I think you're probably more likely to have some sort of exogenous negative shock that forces the power price up than the other way around. And I think, there's this other thing that if the price falls too low, there's assumption about renewable capacity that's going to come online. I think if that were to be too low, ultimately some of it's not going to get built. And I really think that you don't need a lot necessarily go wrong to find there's a lot more sort of upside in that. And I just think, once again, we as analysts need to do some work on that. We're gonna try and do something. We're gonna try and speak to some of these guys and just get a bit more under the hood of that. But I think, if that's the case, and there could be upside in the NAVs, these discounts just look even more ridiculous.
Yeah, I've got several of these in my portfolio, and I can't say I've timed it that well, but I am being paid to wait, and that's actually
that is the thing, isn't it?
To hopefully see some of these things change. We'll just whiz past, I think, Saba Capital, because you talked about it in your section.
Yeah.
And the only thing is, I think I would say there has been a shift in their strategy so that they're now moving into alternative assets as well.
Yeah.
Take stakes in SDC, LNG efficiency, and life science REIT. And of course, the difference there is that those assets can't be hedged in the same way.
No.
It is a step change in their strategy.
Yeah. One thing I might add to this, because it's interesting, is, I sort of mentioned it briefly earlier, are we going to see any new capital? Are they going to be able to raise new capital, or are they going to somehow roll their existing stakes into this? It's not going to add the new demand that I was talking about if they're literally just reshuffling the deck chairs. And I think that's something else to watch for.
Yeah, I think they're such a big player in the sector. We can't ignore that. We just have to.
No, absolutely.
So just two other things I think to go. We've done quite well getting through this, Matt. Valuations of markets. We know that markets have been on a tear over the summer. The US market keeps going up. The PE is about 27. I've noticed in my conversations with managers over the past couple of weeks in particular that they're talking about future growth in their portfolios needing to come from earnings growth rather than from any multiple expansion. And that's code for we think the markets are quite high.
Absolutely.
Quite interesting if you have big winners in your portfolio. If you've had, for example, the tech trusts that have done fantastically well, should you be top slicing a little bit? I think that's quite a sensible strategy at this point. You don't have to sell out completely, and I'm all for long-term investment. But I do think when you've seen what is perhaps an extraordinary rise in markets, they're just moderating your risk, mitigating it a little bit by taking some of your profit is not a bad idea.
Not at all. I mean, what you're describing here is fundamentally good portfolio management. As your sort of thesis plays out, it generally makes sense to, take some money off the table, not be too greedy. I mean, there is this quote, I can't remember who said it, but basically, you make money by, was it sort of buying too soon and selling too early, etc., that kind of thing. And I think, where perhaps I've seen some of the really big mistakes in fund management is where, people have been, or managers have been wedded to a particular idea or a particular stock, and they've not locked in some profits and de-risked it on the way up, and then got called out on the way down. And I think you were saying about the sort of code for no more multiple expansion. Well, yeah, we always hear that when markets are looking toppy, people are saying, right, okay, this is pricing in a degree of expected growth, and if you do not get that expected growth come through, what usually happens thereafter is you get a sharp correction and valuations go back to sort of, where they were previously. So I think, definitely be doing what professional investment managers should be doing and actually locking in some profits. And look at valuations. I mean, escalators don't go to the sky, do they?
Well, they don't, and unfortunately, when markets do go down, they tend to take the lift. They go down quite quickly. So I'd just like to finish actually maybe on a positive note, because I'm wary of being too negative about our sector. We've been talking about contraction, about the difficulty of managers allocating when there's so much competition, about higher interest rate providing so much competition for our assets. But actually, I think we have to remind ourselves that investment companies are still doing an excellent job of providing returns to us in sectors that we can't necessarily access as. So I think it's very notable. I picked out 3 recent winners here that I think illustrate different positive aspects of our industry. First of all, Golden Prospect Precious Metals, obviously I talked about it at the top of the show. It's been a winner for the last couple of months. Huge returns, actually, 120% in shares over the last year. But this is an £82 million trust after this growth. And I think we've got to be very wary of castigating trusts for being too small. A lot of small specialist trusts can be excellent investments. So I think that's a good demonstration of that. The second one is Tetragon Financial Group, an oddity this, which has terrible governance. The shares are non-voting, and there's lots of reasons not to own this. And it's had a massive discount, which hasn't narrowed that much. It's still a 50% discount, but the shares are up 85% over the last year. So I think this is just an example of where you don't need everything to be perfect. And I think perhaps this speaks back to the point about investing in these trusts with very wide discounts. Not everything is going to align, but if the value is really there, there's a good chance.
Yeah. Absolutely. I think, all of these to a certain extent illustrate the sort of point that you can see the value. Okay, you don't necessarily know when the catalyst will be, but this comes back to the point that we were literally just saying a moment ago, that actually if a professional manager can see value somewhere, they should be slowly tilting into it and sort of buying that, trimming some things, locking in profits, allocating to areas that you think are cheap. And I know a lot of Fidelity or China special sits is a sort of classic illustration, but I know other Asia managers that have just been going, look, India looks expensive, China looks great value, don't know when the tide is going to turn, but so many things. I think, for example, Pacific Horizon has really ramped up its allocation to China. These funds should be benefiting as a sort of result. I mean, I think Tetragon's an interesting one, because you're right. I mean, there are these sort of governance concerns, etc. I mean, I think provided there is a route ultimately to getting that value out, then that is great. And of course, it makes sense to sort of buy these things when they're cheap. But I mean, it does come back to this sort of governance concern, and there are equally situations, and I'm I'm not going to name any, but we can think of those funds where there have been serious governance concerns, and actually plenty of money has been made, but somehow it's never made its way to shareholders in the extremes. I think there is something to be said for that old sort of Buffettism of actually investing with people that you trust, and this is why sort of governance is very, very important. I mean, Golden Prospect, I think that's a sort of great little fund. It's taken a good while for it to come right, but actually it's what investment companies should be about. It was a sort of it's kind of a sort of unique offering. It's sort of very, very concentrated, focused. But if you understand it, you know what it's meant to do. And of course, it is leveraged to the gold price. And it's sort of done a fantastic job. It's one of those situations where actually small is beautiful.
And I think that's definitely the case. And there's still so much colour and opportunity throughout our sector.
Yeah, absolutely.
I think this was a very useful gallop through the news and the themes. But ultimately, we're still finding plenty of really good opportunities to invest in this sector. So not going away anytime soon.
Not going away anytime soon. Right. Well, it's been a great chat. Thank you for joining us today, Andrew. If I just move on, obviously we show this to you every week, but it is important. So if you find some moments, please read the disclaimer. And we will see you next week, where we're going to have Gresham House Energy Storage, who we've sort of touched on a little bit today. But come back next week and you can find out some more. Thanks, everybody, and have a great weekend.
Thank you.